So as voting stations open in the United States, markets are preparing for increasing volatility. In fact, we've seen slightly reduced levels of trading for European stocks. US Stock 600 currently 20% below the average in early trading. It also comes ahead of the Fed decision, of course. Jerome Powell press conference on Thursday. Bank of England verdict on the Chancellor Rachel Reeves's budget will also come later in the week, but everything's being overshadowed by whether we get clarity and how quickly out of the US. Joining us now to discuss, Richard Wilson, who is CEO of Interactive Investor, which is a subsidiary of Aberdeen with over 400,000 customers here in the UK. Richard, I'm really pleased to have you in the studio. Very good morning to you.
Morning.
Can we start by your thinking on the US election, the results and how it might affect your investors? How do you think about today, tomorrow, the volatility?
Well, first of all, the elections historically, I think it's 6 of the elections since 1980 have been down to under 150,000 voters. So we're in another very close call. I'm no better than anyone else at speculating on the outcome. What the markets will want is clarity. And there's a risk that, as we've seen in a couple of elections in the last couple of decades, it becomes litigious. If it's not clear, then we'll have risk off. But beyond that, historically, when there has been a clear outcome that's been very strong for US equities, for at least for a period, irrespective of which side of the house you're on. I'm not going to call what the latest betting is because that moves around. But job one is clarity. And then secondly, depending on who comes in, everyone believes that if Trump comes in, you'll have a stronger dollar. You'll have stronger equities, a higher deficit through higher borrowing and lower taxes. And if Kamala gets in, there's a suspicion you'll have a slightly softer dollar, less borrowing, and the US equity markets will all be up, but not as strongly.
Are you seeing much adjustment from your 400,000 or so customers in terms of how they're positioning around this?
There has been a little bit of, certainly much more activity. I think we've got 50% increased activity on US markets compared to the norm, and certainly much more than on the UK markets. But you're taxed on UK markets, so you get a bit less volume. Not obvious is the answer. Clearly there's a Trump trade you back the Mag 7, and of course the large US stocks drive the two primary indices. I mean, Nvidia and Apple kind of call the index. So you've got some activity around that, but we're sort of small fry in the UK compared to the US market, so not much to say.
Okay, let's think about the UK budget, the biggest increase in taxes in 30 years. What did you make of it?
Well, the majority of the changes were very well telegraphed. You've got a spend, tax and borrow agenda with numbers that are very high. And the IFS came out and the OBR can confirm that leads to lower growth going forward, a higher debt servicing burden. And of course, the gilt markets have been a little bit ambiguous about their view of that because the yields have gone up on 2 and 10 years. Basically makes the UK a less attractive market to invest in versus others because you've got a higher tax burden. And the irritation, I think, for many of us is that whilst there's clearly a fiscal tightrope to walk, going after some what would be symbolic or illogical taxes like IHT reliefs on agriculture and business property do undermine entrepreneurship in the country. We've got millions of people where the bedrock of our future is on entrepreneurship, which comes from family businesses. That's not a sensible way to build growth. In fact, it flies in the face of your growth agenda.
So to be clear, you think this budget was anti-growth?
Yes. No question.
Well, as a business, just as a CEO, what are you doing with that increase in national insurance? Are you going to be? Yep. Does that mean lower wages for your team? Are you going to pass it through in terms of higher costs for your customers? How are you going to manage that?
I mean, we're in a very competitive environment, and the option we're competing with all the neo brokers, the US houses, the UK clearing banks, the European houses, everybody, the pension companies. Our option to move price is zero. So then you're dealing with efficiency and or wages or reduced profitability. I think Rachel Reeves in one of her interviews said, companies will become more efficient, as if we're not trying to do that every day already. So the reality is it'll either be lower profits and therefore kind of lower return and lower ability to reinvest in technology, or you look at your wage bill thinking, how the hell do I solve that?
Okay. So in terms of what comes next from Labour, for Mansion House, there has been a push to try to, and in fact, a whole group of insurers and pension companies agreed to try to put more money into UK-listed stocks. That wasn't mandatory. Does it become mandatory under Labour? Do they target something? Do they make it more compulsory for people to invest in UK-listed or unlisted assets?
Yeah, I think there are there's a problem that the UK has, which is compared to some other countries, Canada and Australia are referenced quite a lot. We have a fragmented pension stock. So the actual size of the pool that you're allocating is not as large as it should be. So there's a task there, which is to consolidate pension assets with a big opportunity across local councils and the public sector has been well documented. The fear that we should have is forcing an allocation of risk which is disproportionate. That would conflict with your kind of risk management and the members of your long-term pension holders. So that's not a sensible thing to do.
But Labour will say, how do you get growth? And people have been complaining about the fact that the UK market is undervalued and that we've seen a massive decline in investment in UK stocks.
So there are two things there for me. One is you've got to create the scale of pension assets so that you can make an allocation which is proportionate of a much bigger base. And secondly, we've been bleeding out the UK stock market with stamp duty for the last 20 years. The previous government didn't sort it either. I'm not sure it's too late. It may be too late to save it. We are taxing the thing out of existence. The UK stock market is untradeable, and you are taxed to invest in UK companies, and it's tax-free to invest in US. It's not complicated.
Okay, Richard, thank you so much for being with us this morning. Richard Wilson is CEO of Interactive Investor. Very good to have you on the programme and get your views on the UK budget. His, damning view really on what the UK has done in terms of investing in listed stocks, taxing it out of existence.